Welcome. Let's get started. Credit scores are a central part of our financial lives, but for many, their inner workings remain a mystery. Understanding what makes up a credit score, how it's calculated, and the ways it can impact your life is vital to navigating the world of personal finance. Let's unravel the mechanics behind credit scores and discover why they matter so much. At its core, a credit score is a numerical expression of your creditworthiness, or the likelihood that you'll repay borrowed money. It's a way for lenders, such as banks and credit card companies, to quickly assess the level of risk they'd be taking by extending you credit. The most widely used credit scores in the United States are produced by two companies, FICO and VantageScore. Although each uses slightly different algorithms, their scores generally range from 300 to 850, with higher scores indicating lower risk. But how is this number actually determined? The answer lies in your credit report, which is a detailed record of your borrowing and repayment history. Credit bureaus like Experian, Equifax, and TransUnion collect information from lenders, utility companies, and sometimes landlords. This information encompasses the types of credit accounts you have, your payment history, outstanding debts, and more. The credit scoring models then analyze this data through several key factors. The first and most heavily weighted factor is payment history. Roughly 35% of your FICO score is based on whether you pay your bills on time. Missed payments, accounts sent to collections, bankruptcies, and foreclosures can have a significant negative impact. Conversely, a long track record of on-time payments boosts your score. It's not just about credit cards, car loans, mortgages, even some utility bills can be reported and affect your score. The next major component is amounts owed, making up about 30% of your score. This doesn't just mean the total sum of your debts, but also how much of your available credit you're using, a concept known as credit utilization. For example, if you have a credit card with a $10,000 limit and a $2,000 balance, your credit utilization rate is 20%. Generally, the lower your utilization, the better. Most experts recommend keeping it below 30%. High utilization suggests to lenders that you may be financially overextended, which can lower your score. Length of credit history is another important element, accounting for around 15% of the score. This measures how long you've had credit accounts open, including the age of your oldest account, the average age of all your accounts, and the age of your newest account. Longer histories suggest more experience managing credit, which is viewed favorably. Opening several new accounts in a short time frame can lower your average account age, which may decrease your score. The types of credit you use comprise about 10% of your score. It's beneficial to have a mix of credit accounts, such as credit cards, installment loans, like car loans or mortgages, and retail accounts. This diversity shows you can manage different kinds of credit responsibly. However, it's not essential to seek out new types of credit just to improve your score. Responsible management of existing accounts is most important. Finally, recent credit inquiries make up the last 10%. When you apply for new credit, lenders will perform a hard inquiry, which can slightly lower your score for a short period. Multiple hard inquiries in a short time can be seen as a red flag, suggesting you may be seeking lots of credit and possibly facing financial difficulties. On the other hand, soft inquiries, such as those made by you to check your own score, don't affect your rating. Now that we've broken down the components, let's explore how your credit score affects everyday life. Lenders use your score to determine whether to approve your loan or credit card application, and what interest rate to offer. Higher scores unlock better rates and more favorable terms, which can save you thousands of dollars over time. Your score can also influence non-lending decisions. Landlords may check it before renting to you. Insurance companies might use it to set premiums. And even some employers look at credit reports when hiring for positions that require financial responsibility. Improving your credit score is a process, not an overnight fix. The most effective steps are straightforward. Pay your bills on time, keep your credit utilization low, avoid opening too many new accounts at once, and maintain older accounts when possible. Regularly checking your credit report helps you spot errors or signs of identity theft, which can be disputed and corrected. If you have negative marks, such as missed payments or collection accounts, time and consistent positive behavior are the best remedies. Most negative information falls off your report after 7 years. Despite its importance, credit scoring isn't infallible. Errors can occur, and some factors, like medical debt or sudden financial hardship, may not reflect your true ability or intention to manage credit responsibly. That's why it's critical to review your credit report annually, a right granted for free by federal law. If you find inaccuracies, dispute them directly with the credit bureau and the company that reported the information. There are also misconceptions about credit scores. For example, checking your own score does not harm it, contrary to popular belief. Closing old accounts can sometimes hurt your score by lowering your average account age and available credit. And while carrying a small balance on your credit card doesn't help your score, paying off your balances each month is the healthiest approach. Beyond personal habits, the broader financial landscape can impact credit scores. Economic downturns, changes in lending standards, and updates to scoring models can shift how scores are calculated and interpreted. In recent years, some models have begun to incorporate alternative data, such as rent and utility payments, to provide a more comprehensive picture of creditworthiness, especially for those with limited traditional credit histories. Credit scores are powerful, but they are just one piece of your financial puzzle. They don't measure overall wealth, income, or financial stability. They're a snapshot of how you've managed borrowed money. Building and maintaining a strong credit score opens doors, but true financial health comes from budgeting, saving, investing, and planning for the future. In summary, a credit score is built from your payment history, amount of debt, length of credit history, types of credit, and recent inquiries. It's a tool used by lenders to gauge risk, and it impacts many aspects of life beyond borrowing. Managing your credit responsibly, staying informed, and addressing issues promptly are the keys to a strong score and a stable financial future. Understanding how credit scores work empowers you to take control, making smarter choices today that will benefit you tomorrow. Thanks for watching. Be sure to like, comment, and subscribe for more.